Hello, welcome to our fall market update. David Shapiro here with the Shapiro Real Estate Group, and Lee Abraham, our Senior Vice President of Acquisitions and Agent Training. Excited to have him here. Lee and I have known each other for about 5 years, and I've learned a ton from Lee. He's got a long background in real estate. He went to college for real estate, one of the few people, and has been living and breathing it for ever since, over 30 years in the industry. He also was an appraiser and owned an appraisal company for 15 years. So he has a very strong analytical background. So very excited to have him on this call and on the team especially, but to help talk about what's going on in the Austin real estate market. We'll talk about the macro market as well. So we're going to also want to answer some of the age-old questions, like, is it a good time to buy? Is it a good time to sell? Should I be investing in Austin real estate right now? And, I keep mentioning Austin because a lot of the news that you might be seeing is on a national level. And remember, real estate's always local. So just because nationally one thing's happening doesn't mean that's the same thing that's happening in your local market. Sometimes it could even get hyper local and be based on neighborhood. For example, if they decide to build 50,000 homes out by the Tesla plant, is that really going to have an impact on Westlake home prices? Probably not. There could be an argument there's a little bit of a trickle down effect, but overall, it's not going to have much of an effect because things are hyper local. We're going to answer some questions that have been coming up a lot. Well, what about all these forbearances that are ending? Isn't that going to lead to a bunch of foreclosures and I can wait around for a deal? Well, what about the rising interest rates? Are those going to impact Austin real estate? And isn't Austin not that all that much affordable now that prices have gone up 30% or more in some areas since last year? So we'll talk about all of that. We'll start with some macro predictions. So there are a lot of articles have come out, things like this that Zillow published. They revised their projection for the next 12 months up to 13.6% appreciation for home prices nationwide. And again, remember, that's nationwide. So what we see in Austin will likely be different and most likely be higher than that based on what we're seeing. And we'll continue to talk about that. This other article that was in Fortune talks about some other authorities that have made price predictions. There's another one by Goldman Sachs. It's around the same. They predict 13.5% on an annualized basis. A whole host of ones. The lowest one, I guess, which would be curious, would be the Mortgage Bankers Association. And they predict a price decrease of 2.5%. And that's mostly influenced by higher mortgage rates. And we'll talk a little bit about that. A whole bunch of things going on there with mortgage rates potentially changing in the Fed. We have this interesting dynamic where inflation's clearly going up, but we have so much debt as a nation. It's hard for the government to raise interest rates substantially because that's going to equate to us paying more interest as a nation. And so they can't raise rates all that much, but there's certainly room to raise them. One thing that's in this article is mentioned is that if rates go from 3.1%, what they're sitting at right now, to 3.6%, a 0.5% increase, for somebody buying a $500,000 home, their monthly rate goes from $2,100 to $2,200. So it's about $140 difference per month. And this little fun fact they add here, an additional $50,000 over the course of the 30-year mortgage. A little bit of a pet peeve of mine when things like that are stated, because it's a little bit sensational, but I don't think people are making decisions, oh, it's going to cost me an extra 50 grand for this home. They're not looking at it like that. They're looking at the monthly payment. And if they can afford the extra $140 a month, which at some of these lower price points, it's maybe a little bit harder as you go up in price points. Buyers tend to have more financial resources and there's more elasticity. And so a 1/4 point, a 1/2 point interest bump on somebody, even though on $1 million or $2 million purchase, that is actually a larger dollar amount change. A lot of times those buyers are less sensitive, so it doesn't have the same impact.
One of the things that we look at also at the upper end of the market for volatility, price appreciation, some of the key things that we track isn't so much the interest rates, to your point, it's the stock market, the liquidity factor, and the equity markets. And so there's a lot of moving pieces as we get into making our forecasts across the different segments.
Yeah, and the other thing is at the really high price points is sometimes loans aren't even part of the equation. So
Right.
they're obviously not impacted by that. And we've seen a good amount of cash buyers this year. I think anecdotally, people in Austin have heard that, like, oh, it's just California cash buyers coming in. And certainly there were a good number of those. Some of those people plan to refi out after the fact. So mortgage rates are still a part of the equation for them. Some people are just getting mortgages because rates are so low and they just are like, well, it's only 3%. I might as well get the mortgage, but they have the cash. All these things are out there happening. So that's another interesting article. I mean, our prediction as we kind of look here in Austin will start to become clear as we look at the full picture of what's going on. And this all comes back to supply and demand. So on the demand side, we have the announcements, all the jobs moving here, the Tesla factory, the Samsung plant are the newest ones. And all of course, prior to that, Apple's new campus, Oracle. The story just keeps going. And I think the way this works with momentum is that it just makes it easier and easier for more companies to come here, because now that's created more talent coming here. And the number of people I've chatted with in the last couple of weeks that are just coming into the market as buyers, and they're super excited. And it's pretty interesting to chat with them and hear their perspective coming from other cities. They just see so much opportunity in Austin. It could be from a job standpoint. It could be from a friend social standpoint, dating standpoint. One person told me she just sees opportunities in everything here in Austin, which is really cool. Somebody that's been here for 11 years now. And I love this city. And I certainly see it growing and there being more things around, just whether it's like, well, now we have a Soho House and an Equinox, things that weren't in things I could go to even even 2 years ago, I should say. So those things are coming. So let's talk about what's really impacting supply. So that's on the demand side, lots of people moving here, lots of jobs coming, and then all that momentum. So let's talk about supply side. Well, the macro picture of the supply side, you can look at housing starts across the US. And so this is how many new homes are started for construction every, I guess it's, this is monthly. You can see May, June, July, August. Yeah. So you'll see what happened coming out of the 1990s, heading into the 2009 financial crash. Housing starts were almost at a peak, although interestingly, they were higher in the 70s. But from there, all these builders got hit really hard and there was an overcorrection and the housing starts dropped substantially to a point where they were below even 1966 lows, which is pretty crazy to think. A country that had grown so much from the 60s to 2010 was now building less homes. But it didn't really become an issue until more recently, and obviously we've picked up the housing starts, but this isn't something that you can just flip a switch and produce enough homes for everybody. It takes a lot of time. It's a matter of skilled trades, about zoning. There's so many factors that go into this, but basically we're somewhere in the $4 to $6 million homes shy of what we need right now. And so that's going to take some time to work out of the system. And reading articles, and I'm kind of like a economics nerd. I love listening to podcasts on this stuff and reading up on it.
Well, I think, one of the things that we're looking at when you're talking about the supply side and unit starts is complicated in the current dynamic by the supply chain issues. David mentioned skilled labor, but also, the availability and pricing of basics such as lumber and concrete.
Oh yeah, that's what I was gonna say, is the supply shortage that we're seeing everywhere. One of these articles was saying that the one thing that's gonna take the longest to work out is the supply issues with the real estate market.
Right. And so the bottom line, the takeaway after you look at the charts and the numbers is that there's a fundamental imbalance favoring demand. Demand is outpacing supply. That puts upward pressure on pricing, creates more of a seller's market. We'll get into some of the details there. And, ultimately it's a matter of, hey, what's happening now? How does it relate to the past? What's the pattern? But ultimately, what do we forecast? And we'll be getting into some of those details here in just a few minutes.
So I'll jump into this chart that I started tracking at the beginning of the pandemic, which I think is pretty interesting to see the change here. So when I started tracking this in March of 2020, I thought we were going to see, well, nobody knew what was going to happen here with how the real estate market was going to bounce back. What we see here is the ratio happened to be 1-to-1 of about 1,800 homes on the market and about 1,800 that were pending. As we went into lockdown, you can see what happened was that went up to a ratio of about 1.45. And then Texas opened in May, and people tiptoed out and we were like, it's okay to buy a house. But then all of a sudden, the floodgates opened and people started buying in record numbers. And the number of active homes was sitting around 2,200, about 1,800 pending. You can see the ratio there. And this active number of homes, they just started getting swooped up in crazy numbers. The pending kept going up, or stayed around the same 2,200. But the number of active homes just kept dropping. I mean, you see here, we get to the end of 2020 and it's now below 1,000. And seasonally, that's pretty normal that there's less homes on the market in the fall, in the winter. So we expected as the spring hit that we would see more homes come on the market, but that's not what happened. The number of buyers just outpaced the number of sellers by a crazy amount. And you can see, the number of rolling 7-day sales closings over here, pretty consistent in that like 200 to 300 range. Was over a little 300 there for a little bit. But the number of homes going into the summer, we're like, oh, wow, this is just getting insane. They started to come up a little bit. We started to get some more inventory, a little bit of relief. This ratio is all the way down to a third and started to come back up to about 0.5. And it's a little bit of relief, but still nowhere near where this market should be in terms of the number of homes on the market. There should be like 4,000 or 5,000 homes on the market. And we can go, let's fast forward to today. We're sitting at about 1,000 homes, 1,100 homes on the market. So we're well below where they should be in terms of inventory. So this is from our most recent email newsletter. Let's start inventory since that's what we're talking about. So you can see 2017 in purple, 18, right, 19, and inventory just year by year, slowly going down. 2020, even the start of 2020, you can go back. I recorded a video right here and talked about how we were going to have a very hot year in 2020 just because the inventory was dropping. Of course, we didn't expect it to fall off a cliff the way it did. And then starting in 2021, now it's up a little bit, right? So that's good. We're still not anywhere near 2019 levels. So you can see what a vast difference that is. And so what does this do for the average home price, the median sales price? Well, here it is. So you can see it's been gradually going up and then just took off in 2021. And this just shows the number of sales. So you can see 2020 had actually more sales than 2021. In my opinion, it was only because we didn't have enough homes to sell, right? And so the total volume of homes is up because prices were up and people had to pay more to get a home because there weren't that many. And so can the supply change drastically? The thing about Austin is that it takes such a long time to build. We have a 60-unit apartment complex that we're a part of developing, and that took 2 years to go through the city site permitting process. If you look at these towers downtown that you're seeing go up, by the time you see it break ground, they've probably been working on that project for 3 or even 4 years. By the time it completes, it's a 5 to 7 year project. So the supply just can't change that drastically. Austin is a very difficult city to develop in, much more difficult than a Dallas or a Houston.
Yeah, there's really many variables in place that are kind of limiting the availability of new inventory hitting the market. And so as you make your own forecast and what makes best sense for you, whether you're buying, selling, or investing, and you're trying to make sense of the supply-demand dynamic, we don't see the supply side changing anywhere, anytime soon, particularly as it relates to demand, which again is, interest rates or, sudden changes in the stock market. You're going to see that show up much more quickly.
I pulled some of the local stats. This is the median price over the last 5 years for residential in Austin. So you can see the pretty steady increase and then the jump there. This is how many listings were active versus sold. So there's generally a nice big spread here. So you can see how far apart those numbers should be. And as we got to 2019, 2020, all of a sudden they start converging because we just don't have enough active listings to keep up with buyer demand. And then they invert, and this is in that crazy period in the spring and early summer of 2021 of this year, how they invert, which is crazy. And then it looked like we had some relief, but you can see what's happening again. We're heading back towards them inverting, which is great if you own real estate and you want to see prices go up, but it makes it a little bit challenging for buyers.
Yeah, and for folks that are banking on the traditional seasonality, we're maybe seeing some of that on the supply side, but not on the demand side. And so again, it's just a very unique and unprecedented market that we've been making sense of for the past year and a half plus.
$536,000, up 21%, the median sale price. Closed sales down. Again, I really just think because there weren't enough of them, because new listings, active listings, everything else was down, but pending sales are still up over last year. Average days on market down. So it's taking 21 days to sell versus 30 a year ago, and total volume up 2%. So
yeah, so just bottom line fundamentals, supply's down, demand is up, and the forecast is for that pattern to continue and likely accelerate into the second quarter of the new year.
And as a side note, if you want to be getting this market update from us via email, which has some other things in there as well, if you go to our website on the top, there is a place where you can subscribe, and you can go there and at your leisure subscribe to our newsletter. All right, well, let's talk about forbearances ending and this flood of foreclosures that people are talking about, which I found some data from the Fed. And as of late September, 2.7% of outstanding debt was in some stage of delinquency, a 2% decrease from the fourth quarter of 2019. So delinquencies are down from pre-pandemic levels. Of the 412 billion of debt that is delinquent, 300 billion is seriously delinquent, which is more than 90 days. The forbearances and other supportive policy measures continue to be visible in the delinquency transition rates. The share of mortgages from that transition to delinquency ticked up slightly to 0.5% from the second quarter's record low of 0.4%, as the option to enter forbearance is no longer widely available. Meanwhile, the majority, 50%, transitioned to current. So basically what this is saying, and I'll show you in charts here, is we don't have an issue with forbearances going to foreclosure. This is mortgage originations by credit score, which I think is super interesting. If you look at 2003 to 2007, the 620 and under, and then 620 to 659, this is how many mortgages were being originated with those credit scores. Well, after the housing crash and financial crisis, that was remedied. And you can see we really don't have an uptick in subprime borrowing. So that whole subprime mortgage crisis, that is not lurking like it was in 2008, even though prices are high. Well, what if interest rates go up? Now, we talked a little bit about this at the beginning, that the US government's a little bit hamstrung by the fact they have so much debt that raising interest rates would increase their interest payments significantly. So they can't raise rates a lot, although they've already forecasted that they're going to raise rates in 2022. Sounds like it's not going to happen in the first half of the year. I've seen projections like, maybe quarter to a half a point by the end of the year. Here you can see we're at 3.1% on average for a 30-year fixed rate mortgage, with an average of 0.7 points, which is a fee. Sometimes you hear like, oh, this loan has 1 point. Some loans have no points. So the average is 0.7. A year ago at this time, the 30-year fixed rate mortgage averaged 2.72%. So we're up a little over a quarter point in a year. That is not enough to impact affordability on a broad scale. Of course, for an individual, it could. There are people that are at the very cusp of being able to afford the home they want, and a quarter point is enough to knock them out. So a half point would knock out some other buyers. A full point would be significant, although it's not looking, for what I'm reading, that we're going to see a full point raise in mortgage rates over the next year. That would put the government doesn't want to halt the real estate market. They want this to be a soft landing, a very gradual increase. So I'm not anticipating that that's going to be something that's going to have a huge impact in 2022. But as we get into 2023, if inflation's still going and they feel like they can get away with raising rates further, that could continue to impact it. And then it just comes back to the overall supply and demand dynamics of what's going on in the Austin real estate.
Right. And the thing that is a bit abstract to measure is at what point would an increase in the interest rates actually result in a decrease in price appreciation. And so when you're, looking at those questions that we posed at the beginning, is this a good time to buy, sell, or invest? Particularly on the buy side, if the target market is at the upper end of their affordability, it just puts a little extra motivation to get busy in the current market while rates are still, relatively low comparative to last year, the anticipation of the rates going up. So just more pressure on the demand side to get into the market and make a smart decision for you.
Talking about affordability, so one question people think is, well, I mean, is it even affordable now in Austin now that prices have gone up 30%? And it's a pretty interesting conversation to have. One way I look at it is, how do we compare to our peers, other cities that people are considering moving to? The one that always comes to mind to me is Southern California, Los Angeles, San Diego, because the one thing that those places have that Austin doesn't is year-round 70-degree weather. And so that would be, if I'm looking at if I wanted to take a step in a direction where it could have a benefit over Austin, that's really the only thing that draws me there: beach, things like that. So you look at Los Angeles, just from a quick Google search, you can see that the average, the median home price there is about $800,000. Now, the city of Austin, and that's LA County, right? Not just the city. You look at Santa Monica and some of these other places where people really want to live, and it's probably $1 million plus. Whereas in the city of Austin, it's only $600,000. So we are somewhere between 60 and 80% of the, 60 to 80% of the cost of buying a home in LA. Now, that's not the only factor people are looking at when they're making these moving decisions. They're looking at affordability overall. So things in Austin tend to be cheaper than our peers like New York and San Francisco, LA in general. Of course, then you have the tax issue. So even if pricing of homes were exactly the same, there's still this big tax difference of about 13 or 14% that people are saving for moving to Texas. So that's still a thing. And then, of course, there's the lifestyle of it's just easier to get around, the community, and some of those things. Some people like Austin, no matter what the pricing is, over some of the other markets because of the vibe and what's going on here. So, but for some people, it is truly a financial decision, and they're going to be looking at these numbers. And we're still far enough off from these other cities that there's still a huge, even with prices going up 30%, there's still a really big benefit of somebody moving to Austin when it comes to buying real estate.
And we find typically that residential real estate, owner-occupied property, largely purchased on emotion. I mean, clearly the economics, the pricing, the monthly payment, those sort of things are critical. But there's a way to rationalize, justify, put a plan together when you fall in love with a home and a lifestyle. And, we are finding that there's just so much inbound migration and a building of community that the momentum really doesn't seem to be letting up. In fact, it seems to be picking up the pace.
Yeah, and I think we can both talk about anecdotally what we've seen here. There was talk maybe a month or two ago about there being a lull in the market, and I think I put out somewhere just kind of showing what that means. And you've seen in the stats, like that lull was very little, and it wasn't a market decline, although there are instances where people are very motivated to sell because of their life circumstances. And maybe because there wasn't as much activity as there was in the summer, they saw a decrease from the peak of the summer, but all these things are above 2019 and 2020 levels for the most part. So anecdotally, what Lee and I have been seeing in the market is with our buyers coming in looking for homes, there's just not enough out there for our buyers to find what they're looking for. And, one side note of conversations around town, people are like, oh, you're in real estate. Oh man, the market's awesome. It must be an amazing market for you. And my response usually is, what would be amazing is if there's enough homes that everybody who wants to buy one can just go out and buy the exact home that they want. That would be fantastic. And the sellers, they get a fair price and everybody's happy. We're at some sort of equilibrium. That's not where we're at right now, but it is still possible to get buyers into homes that they're super excited about and they love. And we've been doing that throughout the year. We've helped probably 40 buyers this year get under contract on homes. And so it is possible. So anecdotally, one of the stories that I love here about what the lull looked like is a home that was listed for 1.4 million for about 30 days. They reduced the price to 1.375. And then over the course of the next week, all of a sudden, I reached out to the agent because I was curious about it as a comp or something, and found out that it had gone pending, and thinking, oh, well, it was reduced and, been on the market. Maybe it went for a little bit less. It actually sold for 1.45 million. So it went 50K over the original listing price after being on the market 30 days, because just out of nowhere, buyers came into the market. And so anybody looking to buy in this market, something to be prepared for is when you see a property that you would consider, you got to move on it really quickly, because things can change in just a 24-hour period in this market. And it could go from you being the only one looking at this home, making an offer and being able to get it for under asking, to there's somebody else, you love it, it's the only option, and now you're paying over asking after being on the market. So don't wait. If you see something that you like, reach out to your real estate agent. If you don't have one, reach out to us and we'll talk to you about representing you and moving really quickly. And that's how we've had so much success this year, is encouraging people to not sit on their hands if there's something that they like, because it just changes so fast. So I think that's a good anecdote of the little bit of the lull, and then boom, just like that, we're back. And the market is picking up and accelerating here in the between Thanksgiving and Christmas, or actually it was prior to Thanksgiving, all that was happening. So between school getting in and the end of the year, more than I anticipated. And to me, that's a sign of what's going to come here in the spring. And I am anticipating that we're going to have a very strong spring. And just a little side thing, as we were talking about affordability, but I did want to show this, which is house prices in all top 50 markets are more affordable than their housing boom peaks, meaning in the 2006 housing boom, which is pretty interesting. And as you go through this and look at what that means, they're taking into account mortgage rates, right? So even though prices are up, rates are lower, so that helps with affordability. So many of the markets in the US are actually still more affordable than in 2006. So I think that's a good sign that the party can keep going. And with all the other elements that we've talked about, that is what we're forecasting.
Yep. And so if we're looking at relative stability in the interest rates with a trend for slight uptick, obviously, we talked about that point at which they cross over begins to impact pricing. But here in Austin, again, we seem to be well insulated just based on the macros, the inbound migration of tech dollars, jobs, high paying jobs at that, really is driving our economy. And we're not forecasting that to be slowing up anytime soon.
Let's answer those age-old questions. So is it a good time to buy? Well, we're at all-time highs for pricing, but in my opinion, still the best time to buy. Obviously better time to buy would have been a year ago or 10 years ago. But if you're thinking about buying, there's no better time, because it's hard to forecast that we're going to see any decline in prices coming up. So if you're sitting around waiting, thinking, oh, the market's going to decline and I'm going to get an opportunity to buy at better pricing, I've been saying this for years now, and I don't see that as being a possibility. And I like to put my money where my mouth is, because if I'm going out there telling people, yeah, it's a great time to buy, I want to make sure they understand that I really feel that way. I bought another property this summer after the 30% increase. I still feel very confident. And one of the benefits that I have about this, and Lee has, is that we are experts in this field. We have conviction. We are studying this. We're looking at it. We're seeing all these things. And so it's very tough if you're an outsider to the real estate industry, just wanting to buy a home or buy your first or second investment property, to pull the trigger when you see these prices at all-time highs. We are really confident that this trend is going to continue. Of course, there could always be a black swan event, but we're confident that the trend's going to continue and that prices are going to continue over the long term to appreciate in the Austin area.
Yeah, I think one thing that's critical to keep in mind as we look at these big data numbers, the macro supply and demand, interest rates, things like that, that, David mentioned it earlier, is that real estate is a hyperlocal market. And it's critical to not just be reading the headlines, but also to be looking into the details of the specific market activity, the specific sales comparables, and not just necessarily using average price per square foot methodology when you're making a purchase or an investment in a property. Being able to really understand what is the fair market value at this moment in time, what's the forecast for that hyperlocal market for price appreciation, and factor some of those details in. Obviously, when you're making your purchase offer, competing in a multiple offer dynamic, really having a command of those hyperlocal variables is actually the most critical element once you are bought into the concept, particularly in Austin, that there's just way too much momentum, way too much inbound tech money and investment coming in for this to slow down anytime soon. It's possible to make a mistake and it's possible to overpay. And so that's always something that you want to keep in mind in your pre-offer due diligence.
And you can see why Lee is an amazing asset for our clients when they're going through this process, as he is an expert at looking at all of that.
That's what we do.
So in addition to buying for owner occupied, somebody that's looking for their home, investing, again, the property I bought this year was as an investment. And many people are coming to us at this time of year for year-end tax planning saying, wow, I made more money this year than I was expecting. And my accountant said that there's some things I could do with real estate. And so there are things you can do, doing a cost segregation and accelerated depreciation in year one, which is one thing. If you're interested in doing that and learning more about it, we can chat about that. Real estate just has some good tax benefits in general when it comes to investing. So it's a good place if you have good income in other areas to use real estate to help offset some of those tax gains. So it's a good time to invest from another number of factors, that being one of them. We have people doing 1031 exchanges where you can sell a property and move the profits to another property tax-free. So those things are happening right now. We have clients doing that. All right, is that it? Anything else, Lee, you want to chat about on the buy side before we talk about if it's a good time to sell?
No, I think that covers it. Just, once again, the devil's in the details, as they say. And so I just can't emphasize that point enough.
All right, so now those of you thinking is it a good time to sell? Well, my first question whenever somebody comes to me and says, I want to sell my home is, okay, well, why? Is it you have to move for work? Obviously that makes sense. But sometimes people come to me and they say, well, yeah, I just think the market's hot and I want to take advantage of it. Okay, well, where are you going to go live is question one. If you think you're going to come back and buy that same house for less money, in 6 months, a year, because the market's going to drop, it's pretty unlikely. It's super hard to time markets. So that's not something you should be trying to do. Do you have somewhere else to put the money? If you have another investment that you think is going to be better, that's a potentially good reason to sell. But if it's not, then you might want to think about holding and selling. One thing I did think about, we were talking about interest rates earlier, is that inventory, when interest rates go up, people are going to be less likely to move. They've locked in their 3% interest rate, rates go to 4%. That's going to be a factor in their decision. So inventory can actually struggle with higher interest rates. So it's not necessarily, we're not sure if, rising interest rates are going to have a significant impact on prices because inventory is also going to go down. There's less options for buyers. That's one thing I meant to say there. But it might be a good time to sell if it's time you need a bigger home and you want to take advantage of lower interest rates before they go up and move into a bigger home, or you need to downsize or whatever's happening. Lifestyle reasons are good reasons to sell right now. Trying to time a market is a bad reason to sell.
Yeah, or selling out of fear that the market is going to crash when you had your big opportunity to cash in. And we're just not seeing that in the Austin area. So selling out of fear is not something that we're advocating at all in this market. If you can hold and it makes sense for you from a lifestyle standpoint, life cycle events, those type of things, there's certainly wisdom in that. And really, where are you going to go? And so if you're going to stay in the area here, it does become problematic. So it's always a great time to sell if you've got something else that's lined up that's a better alternative for you. But buying, holding, keeping the property and letting it rise in value is always a wise strategy.
Yeah, and if you have, $1 million property and prices go up 10% this year, it's adding 100 grand to your net worth, and they could go up 15%. I mean, we'll see. I tend to, with clients that we're talking about investments and things like that, try to be conservative, although you could be too conservative. And it's pretty unlikely we're going to see just another 5% year, which was pretty standard pre-pandemic. It's more likely that with inventory so restricted and everything else seeming to go up, like inflation, right? People seeing this as an inflation hedge, which is another reason that buyers are coming into real estate when you can get a 3% mortgage that's fixed for 30 years, which is great for inflation, and you have the asset. So it's really is a great thing to, some people are just trying to load up on as much 3% debt as they can.
Right.
Included. And then we could talk a little about the seasonality of selling. Lee, do you want to touch on that?
Well, I mean, traditionally the fourth quarter, first quarter, winter lull, the holidays, typically slow. And we're just not really seeing that, particularly on the demand side. The psychology of this pandemic impact has been counterintuitive oftentimes. And just as David was saying, anecdotally, the clients that we're representing on the buy side, we've noticed a real uptick in the demand, more multiple offers in some of the properties that we're working with. So I would not be counting on traditional seasonality, whether buying or selling, to be true. I think it's going to be very busy through the holidays. And I do think that the first quarter is going to be a blockbuster, particularly here in Austin. So the time is now.
If you have any questions, things we didn't cover that you'd like us to cover on a future video, or just a question you want to ask, please go ahead and comment below and we'll come in and answer that. If you want to chat with us about considering selling or buying and you just want to talk with us, we'd be happy to talk with you about your goals, see if it makes sense for you to buy or sell, and see if it's a good fit for us to advise you on that. One of the things that Lee and I are in alignment on is our values. If you don't know my story, I didn't try to ever become a real estate. I was trying to not be a real estate agent. I was a real estate investor, and just by a fortuitous series of events, got my real estate license, and friends started asking for my help. And I realized they wanted the help of somebody they trusted. And I started doing that. And it has blossomed into helping hundreds of people buy and sell in the Austin area, having a team that helps my clients and me, helps me execute on that for my clients. And we'd be happy to chat with you and see if it's a good fit for us to help you hit your goals when it comes to real estate. So go ahead and subscribe to the channel so you get more updates. You can go to our website, shapirore.com, if you want to subscribe to our newsletter and contact us there. We look forward to chatting with you soon, and happy hunting out there in the real estate market.